Students of history will know that price action will often lead the fundamentals, which is a little bit surprising. But if you go back far enough, you'll see that it happens over and over again. During the heart of COVID, you saw U.S. stocks start rallying sharply. And this was in anticipation of stimulus and record deficit spending and the economy ultimately doing well. And you see this during the great financial crisis. You saw, stocks rebounding sharply even in the heart of the recession in 2009. It bottomed. Stock prices bottomed in March 2009, even though the recession lingered. You saw this during World War II, where U.S. stock prices started rallying in anticipation of the U.S. winning key battles in the Pacific. And so oftentimes price will lead action. And so this is an important data point that sometimes you can get key signals from price action. Sometimes it's also a warning. And in this case, I'm talking about Chinese equities as a potential warning for investors. Look at Alibaba stock. This stock is down 70% over the past 3 years. This is really interesting, not only because it dropped. You might say, well, a lot of stocks dropped, in 2001, 2020, 2021, 2022. But unlike many stocks that recovered in 2023, this was down. This flatlined. This is a red light, especially when you look at the underlying fundamentals and you look at a lot of these Chinese equities. The fundamentals actually are showing improving revenue growth, improving free cash flow, trading at, near record low free cash flow multiples, single digit multiples in some cases. So this is a signal from the market saying, hey, there might be an issue here that you're not paying attention to. Another example is with Tencent. Tencent down 50% over the last 3 years. And when you look at what they do, this is a powerhouse for the Chinese economy. 1.3 billion users on WeChat. They power the #1 mobile payment option, #1 mobile browser, games, content, cloud. For this company to continue to post growth and profitability and for the stock to not go anywhere reflects that investors are increasingly worried about the business, about also the macro picture as well. And that key risk might have to deal with this upcoming election in Taiwan. That's going to be happening this weekend, the presidential election in Taiwan. And, you contrast this with what Xi Jinping, the head of China, said just a few days ago. Part of his New Year's address, he's talking, he's pledging to reunify with Taiwan, repeating the same message. He doesn't say the time frame. Some people speculate that they set a hard limit of 2049, but he's saying, we are going to reunify with Taiwan. And just so you know, this isn't just propaganda. Elon Musk, who has an inside perspective of what the CCP thinks because of his investments in Tesla, the production lines there, he says being Beijing's policy has been to reunite Taiwan with China. From their standpoint, maybe it is analogous to Hawaii or something like that, like an integral part of China that is arbitrarily not part of China, mostly because the U.S. Pacific Fleet has stopped any sort of reunification effort by force. That's a really interesting insight by Musk. He's saying that the CCP is not bluffing here. This is really a goal for them. So it is important to go back to, this presidential election in Taiwan, there are 3 different parties competing in this race, one of which, the leading candidate, the front runner, is Lai Ching-te, the current vice president from the Democrat Progressive Party. He's a champion of Taiwan's de facto sovereignty and separate identity from China. So this might be an issue. Now, he's subsequently sort of pulled back on this language, that enrages the CCP, saying, we are an independent force, saying, the status quo is important. He doesn't want to start World War, X. That could be a huge problem. And so he's saying he doesn't want an invasion. But Beijing has rebuffed his offers, calling him a war maker and destroyer of cross-strait peace. That's really strong language for the potential next president of Taiwan. This is the front runner. And so how does this potentially play out for the world? What does this potentially mean for the markets? How am I personally thinking about that? First of all, in full disclosure, this is not financial advice. Also, quick plug, take charge of your investment journey with unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server, available for premium annual subscribers. Got some very exciting ideas to share with you, so come check it out at unrivaledinvesting.com. So I think the near 100% chance of what will play out is there will be at least some sort of protest. The question is, so you have some sort of diplomatic protest. The question is, what are the other more severe actions. I think you also probably have an 80-90% chance of some sort of cyber event where some key infrastructure in Taiwan gets attacked, and who knows if their defenses are strong enough to withhold some sort of cyber attack. So maybe you see something, critical get shut down in Taiwan as a result of an election like this. I think you could also see, I personally would think this is, a 60-70% chance, increased military incursions, exercises around Taiwan. Whether or not that's jets flying over, ships getting very close, I definitely think you'll see something like that, or it's very, very close. And if you were living anywhere else, you would say, wow, that would make you extremely uncomfortable. The possibility of a full-scale invasion, that is arguably the lowest probability outcome, but it would also be the highest potential impact. This is not, you do not want a bloody war, especially when you have the uncertainty of, will the U.S. step up, to help keep Taiwan's independence. And you see, China making their effort to say, hey, look, you have your fleet of aircraft carriers. We're going to build our own. So that way, maybe we go toe to toe someday. And there's other ways this plays out. And this has been a key element that I learned from reading Chip War, which I'll talk about in just a second. But a hot war doesn't necessarily have to be the only option. There's a lot of unpleasant ways that this could play out. China could take steps to enforce a blockade, including the closure of shipping lanes, trade restrictions, and custom barriers. So there's a lot of different challenges here. But I think the Chip War, which is just a phenomenal book, I'm going to read from it in just a second. It provides not only a history of the semiconductor industry, but also helps you understand this bottleneck and why there's such a key challenge here with, Taiwan Semiconductor being the lead manufacturer of these cutting edge chips, the chips that go into the Tesla cars, that go into the rocket ships that we use in our smartphones, that go, they are the monopoly position in the cutting edge chips. And you don't want to lose that because their physical infrastructure is in Taiwan. So could you get some sort of blockade that creates a legit issue? So let's talk about, I'm going to read a key paragraph here because I think it's so thought-provoking. Because I always put the probability of some sort of hot wars as very low, but I think there are intermediary risks. There's risks like if you put a hot war at 5 to 10%, there's other risks that I think ratchet up the risk spectrum in terms of equities and in terms of the global, stability that are sort of this hybrid challenge. And so let me read what's discussed here. So he goes, there are many ways a war over Taiwan could begin, but some defense planners think a ramped up dispute over isolated Pratas Islands is the most likely. That's what you see here, I believe. One recent war game organized by American defense experts envisioned Chinese troops landing on the island and seizing the small Taiwanese garrison there without firing a shot. That's incredible to me. The idea of, here it is, you're slowly taking over the land without even firing a shot. Taiwan and the U.S. would face the difficult choice of starting a war over an irrelevant atoll or establishing a precedent that China can slice off chunks of Taiwanese territories like pieces of soft salami. Another key paragraph here is other options would be easier for the PLA, so this is talking about China's army, to implement in the Pentagon's judgment. A partial air and maritime blockade would be impossible for Taiwan to defeat on its own. Even if the U.S. and Japanese militaries joined Taiwan to try and break the blockade, it would be difficult to do. China has powerful weapon systems arrayed along its shores. A blockade wouldn't need to be perfectly effective to strangle the island's trade. Ending a blockade would require Taiwan and its friends, mainly the U.S., to disable hundreds of Chinese military systems sitting on Chinese territory. A blockade-busting operation could easily spiral into a bloody great power war. And so the reason why I'm sharing this is that this hot war option, even though that's, the idea of a direct invasion is low, there's these hybrid risks, especially if you have a candidate in Taiwan that's pro-independence and the CCP is saying, hey, you are a war starter. That's a big concern. And so it makes you think that these hybrid risks, like some sort of blockade, could play out. And I think that's part of the reason why you're looking at Chinese equities and they haven't rallied, even though their underlying fundamentals have improved since the lockdowns have eased up in China. So this is a very, interesting and concerning macro perspective. Now, what do I think investors should consider? Always bring it back to you and think about your own investment portfolio or your own investment journey. I think it's critical to recognize, you read the Warren Buffett letters, and you can go back when he was running his partnership, back in, I believe, the 1950s to now. You will not see macro commentary every given year about like, oh, well, GDP was this and, inflation was this, and this is why, we bought XYZ. He's just looking for great businesses at compelling prices. Now, no one wants another world war or, some sort of geopolitical instability. But I think it's important to recognize and focus on what you can control. You can't control these elements. So focus on, hey, I'm going to try to find the best companies I can that won't be disrupted by potential geopolitical change. And that, it'll still be, running, and it'll still be delivering key products, key profits in the future, and trying to find those types of businesses and pay a reasonable value. I personally call out, what I own, my top holdings. I honestly, reviewing my top holdings, even if there was some sort of incident like this, like for example, one of my top holdings is a insurance company. I don't view this as something that would debilitate them. I view this as they would be able to continue to run their operations. If anything, you'd probably see an uptick in inflation because chips, the chip scarcity, and then, insurance underwriting costs, you'd say, hey, maybe that goes higher, and then they'd pass it on to their customers over time with higher insurance premiums. So that's how I'm personally looking at this, very mindful that, I previously looked at Alibaba and thought, wow, this is cheap. But the reality is the CCP has intervened to such extent, and now you have this, this heightened risk of reunification by force or by some sort of intervention. And I think that's what's starting to get priced in with Chinese equities. The question is, is this a broader risk that could affect the broader market? If this ultimately doesn't play out, I'd argue looking at Chinese equities are trading at very, very cheap valuations. That's too hard for me to stomach. That's not a path that I want to go down anymore. Partly because I don't want to think about what's the CCP doing today. That's just not how I want to spend my days. But I think if you are a pure quantitative investor, you'd look at something like Alibaba and say, oh, statistically it's cheap. But I hope this video has been helpful for you, calling out there might be a real risk here that a lot of folks aren't correctly pricing in, and it's higher. It's a higher risk. It's a heightened risk than a lot of people are expecting. So thanks so much for tuning in. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.